this one today, we have Danielle Hallawi, who is the founder of Kapvista Ventures and a managing director of H1 Family Investments.
I've been in the startup space and the investment space for quite a while, and I wear many hats. And then I have sit on a couple of boards and I consult on a number of companies. My main focus is startup and investments and being in the capital raises.
Your first exit is what laid the foundation for your family office, for Kapvista, and everything else. Getting through that kind of an exit requires a very, very complex political, legal, financial, and technical calculus where a lot of things have to be in alignment in rapid succession. And so I'm wondering if you can talk a little bit about the exit, anything that led up to it, how you performed operationally, and whatever took you from selling car parts in high school to eating dinners with sheikhs in the UAE and the president of Madagascar.
It's a very interesting one. I've always been that person that looks to think outside the box, looking at problems and how to find a solution, which I think is why when I was in my corporate world, because I did work for a number of banks and boutique fund managers, I was always looking at ways to think of, is there a better way to do this, right? And that is what led me into the startup space. I got sick of the corporate world because it was very structured. It was very, this is how we do things. This is how you've got to do things. Don't venture outside this framework. So like most founders, I got sick of being told that, and I went out and did it on my own. Now, to go from being a early stage founder, first time founder, not knowing anything, to having, an exit and exiting on my own startup, but also now going through and having a few other companies that I'm invested into have exits as well. It's one thing that people don't tell you is that it is very difficult and daunting because you have two things that you're trying to focus on at the same time. You're trying to grow and maintain your business, and you've also got to focus on positioning the company in its best possible light so it can get acquired. Now, being on multiple sides of that coin, having an exit plan is necessary, but it may not be the best path. I've known founders who have exited too early and then regretted it. I've had founders that have exited at the right time and then the business has gone on to be wound up a few years later. So it was perfect. Speak to people who have done it, get the right advisors in your corner, and get legal advice. Because I've seen some horror stories. They didn't get the right advice and things come crashing down, or the founder gets screwed over. So get legal advice. I did head to Madagascar at the end of last year, and I did meet the president of Madagascar, and I've met sheikhs from the UAE who buy $1.5 million US racing camels while at breakfast. A phone call, 10 minutes, and they've spent more than what some people will ever earn in their lifetime.
The racing camels are a new one for me. I've heard horror stories from people who raised a $60 million Series A, and then they didn't read any of their legal agreements, any of the term sheets. They just had a lawyer do it, and they were not happy with the outcome. That was why I laughed. It's funny because it's painfully true. The capital markets ecosystem is vast. And so what you're doing between H1 Family Investments, Kapvista Ventures, and then the Kapvista platform is actually very sophisticated operationally speaking, because you've got the oceans that pool the capital into the institutional investment funds, which are family offices, corporations, etc. Then you've got the venture fund itself, and then you've got the associated entity that is involved with Kapvista Ventures. Would you mind touching on your thought process and how they all interact and what you see happening in the future?
Yeah, so we'll go back to the start. I started Kapvista as a way to find the best deal flow for myself and the investors in my network. And then when I started to, go through the process, I thought, well, I can kill two birds with one stone. It is incredibly difficult to connect with the right investors. I come across technical founders every single day who are great on the product side. They're great on the biotech side. They're great on the AI and data side. But when it comes to actually articulating their story and selling the Sizzle, they can't do it. And that's where it falls apart. So what I do and what I think is very valid and useful is being able to take what the founder has put together, articulate in a way that is investor worthy or gets investors excited, because what you might think in your pitch deck is amazing may not hit with the investors. And the prime example of this is the defense company that I'm invested into. Their original pitch deck was put together by the founder. The founder is an engineer. So he put everything in the pitch deck that was exciting to him, because he's an engineer and he likes to pull things apart and put them back together and tinker away in the garage to make things work. But when he put it all into the pitch deck, the investors they didn't know what it meant. They were like, oh, okay, I don't know what these numbers mean. I don't know what anything means. And when we sat down and pulled it apart, and I said, you've got to explain why this is exciting to investors, why it is different, why it is new, why it is, exciting. And that is the point of where we help and where my team help, and why the investors that we work with are excited, because we break down the opportunity and make it attractive for the investors to say, well, okay, I want to find out more. I want to sit in front of the team. And that's one of the key skill sets that I think you need to have when trying to raise capital. Unless you're going to a technical VC that they're industry focused. They know, like if you're pitching to an AI focused VC who is only investing into AI infrastructure plays, and you're a founder of an AI infrastructure play, you can get very technical, because they will understand it and they will understand why you are excited about this. But if you're presenting to a generalist VC, they may not get the same hype over it. They may not get the same excitement over what you're presenting, and you need to reframe it in the right way. So the way that all of our entities work is, I look at a deal and I'll take a look and say, well, is this exciting to me? Can I see the benefit in it? If it is, then can I put it in front of the investors in my network?
The defense industry is actually interesting in the sense that it is truly anti-fragile, economically speaking. A number of family offices are running smaller defense companies like the Verta family office in the Los Angeles area. I'm wondering if you would be able to touch on economics of it, why defense is interesting at this point in time, given what is happening in the Middle East, what has been happening in Ukraine and Eastern Europe, and then whatever else may be evolving in the Southeastern Pacific.
Defense companies are a very different beast. When you're dealing with a defense company, when I'm going out to investors, especially for this one that I am invested into and on the board of, I have to try and be as conservative as possible when I'm going out to the investors, because if I talk in real world terms, the investors think, well, this can't be real. So, for example, the company that I'm invested into, their first contract with Ukraine, their first contract out of potentially 4, 5, 6, who knows how long their conflict will go on for, but the first contract's worth $2.5 billion. So they're going from zero revenue to $2.5 billion with one contract. Now, when you talk to a normal everyday tech startup and they're showing their milestones of going from 0 to 1, 1 to 10, 10 to 100, that's over a 5-year period. Defense is like, well, we're going to go from $0 in revenue, $2.5 billion in revenue in 6 months. And people just don't understand it. So the sheer numbers of revenue potential is out of this world. That's what a lot of investors have not cottoned onto yet. They're starting though. Defense tech for a long time has been a very taboo subject. Over the last 2 to 3 years, things have changed. Over the last 12 months has rapidly accelerated. And a lot of funds are now looking at defense because they see the need with a lot of the conflicts that are in the media. A lot of sovereign nations are now coming to the table and saying, we need ways to protect ourselves. We can no longer rely on bigger countries to be our protectors. We need to protect ourselves as well. So smaller nations are looking for technology that they can buy and bring into their own militaries.
Wow. Yeah, those are obscenely good numbers in terms of defense tech. Both China and these little groups in San Francisco now have robot UFC fighting. And when you look at the ways the robots move, they're basically blind. The way that that works technically is very different than, let's say, a startup that works with missiles. With those developments in mind, would you be able to talk a little bit about the focus of defense products and the scalability?
There is a lot of companies that are building incredible technologies that have dual use, like the robotics companies that you're talking about, where they're building humanoid robots to change the way the military operates. Instead of sending humans into conflict zones, they're sending robots, which is taking that risk away from individuals, which is changing how we go to war. A lot of these technologies have dual use, which is exciting because then it changes the way that society operates as well. It's a fascinating space. When you start to go down that rabbit hole, it's absolutely fascinating.
You're not kidding. Every fund has their own investment thesis. Yours is interestingly spread out because you have military defense companies, you have consumer products such as hard seltzers, you have essentially, meditation apps, and then you've got companies like Audio DNA that were founded by two-time Emmy Award winner James Spencer, who has a daytime Emmy for Star Wars Clone Wars and a primetime Emmy for The Mandalorian. The unit economics of each of those individual sectors is radically different. And so I'm wondering if you would be willing to touch on your investment thesis, whatever portfolio theories behind it, and anything else you'd like to add.
Our fund is a co-investment fund. So we invest alongside people that are much smarter than ourselves, like the meditation app. Ucom is fascinating. It's an incredible app that started life as a $6,000 FDA approved machine. And they have documented 20,000 surgeries, I think, where, for example, people put headphones on and sit in the dentist chair and have, wisdom teeth removed without the need of pharmaceutical. You listen to an audio track, which can be music, can be anything, but behind the track is 2 gigabytes worth of data that changes the frequency of your brain. So it puts your body into such a relaxed state that they can have their wisdom teeth removed without needing drugs, which I thought was absolutely fascinating. And then they pivoted into a consumer model where they released an app. I've tried it myself. I plugged my phone in, I played their audio track, and it helps you fall asleep and you get into a deep sleep, and you can track your on your sleep tracking apps, and it gets into a deep sleep. So I use it myself. They've got like a track that you play while you're working, and it puts your body into a state where you're completely focused. There's an audio track that you play, and it helps you relax, so you get into a state where your body starts to recover. I had a look at the space, and there are 2 big players in the market with Calm and Headspace. They're great, and they're billion-dollar companies, and they have hundreds of thousands or millions of users. But their audio tracks are just audio tracks. There's no hard science behind it. Whereas Newcom, there is hard science behind it. There's something more there. When I looked into it, I'm like, well, can they go from the FDA approved machine to a consumer app and then to scale that app? And yes, they can.
You've touched on international venture economics in terms of geographical variance when it comes down from M&A to valuations, ad infinitum. The regulations, internationally speaking, for offering securities across jurisdictions can be very, very complex. And so I'm wondering if you can touch on the mix of all of that.
For us, we focus on countries that have a similar legal framework to Australia. I'm based in Australia. I look at companies that have a similar legal framework. So any of the Commonwealth countries, so Australia, New Zealand, Canada, The UK, they all operate in the same legal framework. The US is quite similar. Jurisdictions like Singapore and Hong Kong are quite similar, whereas Hong Kong's changing a bit. When we are going to make an investment, we get the right advice. Now, as an investor who is doing cross-border, investment, my advice as an Australian, if I'm investing into the US, then I have a US entity that I invest out of. And I use that entity as the legal entity to hold those investments. So then I limit my cross-border risk. The US and Australia and the UK, they have, from a government level, cross-border investment policies. There's a free trade agreement, but Australia, America, Canada, the UK, they're all very interchangeable markets.
Public market exchanges, and you look at larger companies that have been around for a while, like Facebook, they'll be on the TSX in Canada, they'll be on the NASDAQ in the United States, the LSE in the United Kingdom, the ASX in Australia. But only a handful of actual brokerages are going to offer access to securities across multiple jurisdictions, in spite of the fact that it's the exact same security.
I look at deals globally, and when I have a look at the deals globally, I compare them back to what's in my own backyard. Now, as a US-based investor, if you're looking at an Australian company and you can help them get to the US, there's almost an arbitrage play there. So Australia, we've got some unicorns that are in market. So Atlassian is an Australian company. Canva is an Australian company. Airwallex is an Australian company.
People will talk about how currency risk in private equity is not as much of an issue, but the arbitrage plays are actually quite interesting.
Having a look at trends from a consumer aspect, how we consume content has rapidly changed over the last 10 years. I'm the generation that, on a Friday night, my parents took me down to Blockbuster Video to hire a new movie, and the other option was watching free-to-air TV, which you had to watch with commercial breaks. That went from going to Blockbuster to get videos to then getting cable TV, which showed you 100 channels, but you still watch what they were showing. And then that went into streaming, where you had Netflix, where you could choose what you want when you wanted, and it was on demand. And now that's evolved into watching a movie or a TV show on Netflix. The attention span has shortened, and now we're moving into TikTok and Instagram and watching reels. And now that's changing again into short form dramas, 1 to 3 minute episodes of your favorite TV shows like Friends, The Office, Entourage, and now they're putting onto TikTok, and people are watching entire seasons in 1 to 3 minute bites. And now that's spawned another sector where people are now creating short form dramas in that 1 to 3 minute bite-sized pieces, because the attention span of the consumer or the viewer is getting shorter and shorter and shorter, and that's on demand now. So you have a look at these rapid changes over the space of let's say 10 years, and the way that we consume content is rapidly evolving. So looking at those sort of industries, 4 years ago it was nothing, and now it's a $10 to $15 billion market.
A lot of entertainers have some bittersweet feelings about the vertical series industry. I think the private capital markets are incredibly warm to them. Very interesting dichotomy between the economics of traditional entertainment and what's actually happening in technologies. And so when you look at the public-private dichotomy, the same 4 or 5 sectors. You've got biotech, you've got tech, you've got industrials, you've got beverages, and so on and so forth. Those sectors play out into a lot of private offerings as well. So you look at a crowdfunding platform like Start Engine, same sectors. And I'm wondering if you could touch on the trends, the economics, and anything else you'd like to mention regarding the sector breakdown.
For me, the way I look at it is, where are the eyeballs going? Where is the dollars going, right? Looking at it from a consumer standpoint. Consumers are dictating what the next industry is going to be. Now, the big one is AI. More general consumer households are using AI for their day-to-day life. ChatGPT is a household name now. Everybody uses it. Eyeballs and dollar spend are going there, and that's why we're seeing the rise in AI. The short form drama, we're seeing where the eyeballs are going to, and that's where dollars are flowing into. If we look at beverages and consumer products, right, the market is changing because as a society we're getting a lot more health conscious. Coca-Cola has been an incredible innovator. They innovate by buying companies and increasing their portfolio because they see where the trends are going. They own so many brands underneath their umbrella that they're able to maintain their market share even when the society's trends change. The society is getting healthier. They're more health conscious. Wellness is a big thing. We're going to invest into healthier beverages. Poppy, that drink sold to PepsiCo for $2 billion because Pepsi saw that this healthy drink brand is eating a lot of our market share. We're going to acquire it because we see that that's the future. So having a look at where the eyeballs are going, where the dollars are going from a consumer level, that's where you want to be at the forefront.
Thanks for doing this. This was a lot of fun, and I appreciate the time you took today.
Well, thank you very much. I've had fun as well.
Anytime. Thanks.